shift towards Trump always raises tariffs, risking renewed volatility. So, are the markets too complacent? As baseline tariff has been raised from 10% to around 15 to 20%. So what was done in April was a baseline of 10% was put. Now it has gone up to 15 to 20%. US markets are up, so he is not concerned about markets. Plus, he is getting good amount of money. Every bill he wants to pass, it is getting passed through the Senate and House of Representatives. So he is not having an issue. So he is now free to put higher tariffs, and then they are targeting $300 billion a year from tariffs only as part of their earnings. So he's happy. So why our markets are not correcting? Because our SIP flows have grown steadily, offsetting FIs who are going out. I'll show you this thing also today. Every day now, due to this tariff volatility. So now investing in VUCA world. VUCA is volatile, uncertain, complex, and ambiguous. This is a term used to describe the challenging, unpredictable nature of the modern world, and especially since last year November, after arrival of Mr. Trump. So now what is happening is America's trading partners have largely failed to retaliate against Donald Trump's tariff war. This has allowed Trump to raise $50 billion in just 3 months, April, May, June, in extra customs revenue at little cost. Because US inflation has not gone up. The hirings are good. Markets are at high. So there is no cost to him and he is getting money. Only China and Canada have dared to hit back. European Union has planned counter tariffs but has deferred their implementation, linking them to the 1st August deadline. US didn't even spare their largest trading partner, that is Mexico, and they also didn't retaliate after being hit with 25% tariffs in March. He has threatened 50% tariffs on Brazil, citing political justifications. Even Canada dished a digital services tax under US pressure. What is happening to Japan highlights that trade deficit is more important to Trump than whether you are an ally or you have investment in US or hold US government debt. Realism is getting priced into Indian equities nowadays in sectors, companies that are both beneficiaries and victims of shifting global sands. The prices are correcting and it is getting priced in higher tariffs. Okay. Now, what is the meaning of that is that the margins of the companies will decline because they will pass on some costs, they will have to take on some costs. I'll discuss that later. But it is playing out in two ways. Now, cost competitiveness and diversification of global supply chains are helping India emerge as a major country in contract research organization and contract development and manufacturing organization, that is CDMO services. So outsourcing to India in this field by pharma companies can result in an estimated cost reduction of nearly 75% in R&D and 55% in manufacturing versus conducting these activities in US, irrespective of the tariffs. It is visible in the enthusiasm seen in Anthem Biosciences IPO. That IPO will get a blockbuster listing tomorrow. But the divergence is seen in IT stocks. The IT stocks today need a turnaround plan. The old method of working cannot work. The old method of working was keep high margins because the revenues were given. 8-10% revenue growth was given. Margins were around 20 to 25% and good earning growth with zero cost. Now that is not going to happen, and they will have to reduce their margins so as to get orders. So there will be a big competition among them. So what is happening is Tech Mahindra is trying to get re-rated with a turnaround plan. Wipro showed strong order inflows, but the revenues are declining, margins are declining. HCL Tech is making serious investments to be ready in AI-driven landscape, but again, their guidance for margins and revenue is lower. Hence, it's a divergence between the CDMO, CRMO space versus IT stocks in respect of global trade or who all are exporters. Now, in terms of domestic demand, again there is a divergence. We are seeing weaker domestic demand in automobiles, consumption, real estate, FMCG, credit offtake. So if you see the results of which or the monthly reports which are coming about autos, about consumption, like we have already seen the results of EPAC durable, there is a revenue decline. Uh, Real estate, again, there is a problem. FMCG, there is no growth, but I'll show you where the growth is taking place in FMCG today. And credit offtake, which is being reflected by creditors like Axis Bank, HDB Financials. So now the problem is that even companies like GM Breweries, they saw their volume grew just 3.6% in FY25. They are country liquor makers. So even at the bottom end, people are not able to sell stuff. Then DMart results were below expectations. Revenue grew 16% year on year. Gross margins declined. So if the margins are declining, PAT wouldn't also grow higher than 10-15% due to competition and increased operating cost. Because to hire people, you have to pay them higher starting salaries. Now, stock is priced to perfection, and now questions need to be asked whether consumption can keep pace with valuation, and it can't trade with 10-15% growth. It can't trade at 70-80 times. Weakness in economic growth is seen in credit offtake. Non-food credit has slumped to 9.3%. Axis Bank and HDB Financial showed that retail loan growth is disappointing and a stress in retail loan book is emerging. Lenders are also calling out pain in commercial vehicle lending also, and that was reflected in the results of both Axis Bank and the other updates which are coming from CV Financiers. But at the other end of the optimism spectrum is Ixigo, a tech company thriving on rising travel demand, agile operations, and an asset light model. Even the results of all hotel companies, we have seen two at least till now, ITC hotels and the Indian hotels. Both results have been really good, 30% growth. So what Ixigo showed was strong growth in gross transaction value led by high margin flight and bus segment. They are into basically three segments: flight, bus, and railway. So flight and buses are showing higher amount of margins. It shows resilience of travel and tourism sector in India. 55% year-on-year growth in gross transaction value, 60% market share in train online travel agent. Bus and flight remains as segments with higher contribution margins. So what is happening is they are catering for the tier 2 and tier 3 cities and the not the top 5-10% of the population, but the balanced people. And that is where the growth is coming. So there is a big divergence. And if you can see the Nifty IT, as I was telling, Nifty IT made a high in December and then made a bottom in April. So now it is somewhere in between, trying to see which direction it can go. After the results, a lot of negatives were already priced in. People are always optimistic. So it is in between. But one has to be careful because it is below all the moving averages. Now, coming to FIDI data. So when I was telling about FIs are going out, so if you see here, they have added shorts. So it has reached 1.48 lakh short positions. On Friday, they added major short positions in index futures in Nifty Bank after the Axis Bank results. And if you see in terms of options, they have bought puts and majorly bought puts and very minor positions in call options. So not much of calls have been bought, but they have bought puts. So it means what? That they are negative on index futures and negative on options also. So they are hoping that the market will go down, right? And minuscule buying in cash. So what is Pro doing? Pros are bullish. They have added longs. In terms of options, they added but they have added more put options. So basically, they are uh, from index this thing. They are trying to hedge there, but their also exposure is more towards the short side. Coming to clients, clients have sold call options but have majorly bought or sold put options. So that means they are the counterparty to all these FIs and pros. So they are on opposite spectrum. Let's see who wins. Now coming to month data of FIs and all. So if you see here from 34,000 odd short positions on 26th June, that was expiry day, it has moved to 1.48 lakh. So every day they have been adding short positions on on and they have been selling in cash also. So on the big days when they sell, the index went down around 1% on 18 July and 11 July. And if the day they buy, it goes up around 1.2%. But we have gone below 25,000 now because FIs are turning short. Now, coming to the US, they had a positive week. Key inflation reading in CPI and PPI for June came in softer than expected, allaying worries that Trump trade war would have big impact on prices. June retail sales were strong. JP Morgan and Bank of America had good earnings, so things were considered to be going good. So if you see the US 10-year yield tried to go up and then didn't go anywhere, so it was flat because people are not sure now what direction it'll go, but they are whether there would be a rate cut or not, there would be a rate cut. So it is right now trying to understand how things will play out. Dollar index was also, because of tariffs, started going up, but it is still below that 100 level. So let's see where it goes. Brent crude corrected around 1 to 2%. There is not much of demand which is expected, and there is overproduction. So some amount of geopolitical issues raises the price, and then it comes down. Gold, it always gains on global uncertainty and weak US dollar. So it is along this rising trend line, but it has not yet broken that, but it is off from the highs. So let's see, but I don't think more money is now going into gold. It is going into other asset classes like silver and other palladium and other issues. So silver is making fresh highs. It made a fresh high, then it corrected. But let's see what happens. There must have been some profit booking, but it has broken out here. Copper, because this is a COMEX issue, so as tariffs have been put, so the prices of copper in US have gone up, but not in the London metal exchange. So what is happening is people are playing arbitrage, buying it in LME and then sending it to the US, etc. So it's a proper trade which is taking place right now. So don't go by that, but the copper prices are going to be up. Bitcoin made a fresh high because crypto's market have hit a market cap of 4 trillion because after Trump has signed the Genius Act in law, where where the cryptos are becoming more and more mainstream now. So that's why a lot of money is moving into cryptos, and they had a good rally. After that, it corrected and booked profit, but the prior week was also very strong. Now, US indices fell on Friday, but still they had a positive week. After Trump has demanding around 15-20% tariffs on European Union imports, but July consumer sentiment was good. And then Netflix fell around 5.1%, though despite good results, they have warned of lower H2 operating margins. 3M was down 3.65% after warning tariff impact will hit in H2. So it is somewhere in between. But if you see here, S&P 500 was up, Nasdaq was up, and it is rising, made a fresh high. Even S&P 500 made a fresh high. So there is no worry on the US front. Dow corrected a bit because their constituents' results were slightly off. But these things will move now with the results, and banking results are expected to be good in the US. Now coming to India, uh, India VIX had declined and had come down to around 11 level, and it is at this level. Now, if VIX remains at this level, don't expect any big moves in indices as such, because there is no trade is not taking place, and there is no momentum in the market. Nifty, if you see here on the weekly chart, it had a breakout above that 25,000, and that breakout has been negated in 3 weeks. So three red candles have negated that breakout. So we have come down to the basic level which was before the breakout stage. So it is generally now at 25,000, looking to go down. I think the first support should be around 24,500 based on the uh, weekly charts. If you come to daily charts, what happened on Friday was it took support at 50 EMA after decisively breaking the 20 EMA. So it becomes negative and it is trending downwards. It took support. So if this uh, 50 EMA at 24,930 holds, then it is good. But otherwise, this will then test the 24,500 level, which I was talking about, which is the next moving average. Coming to the hourly chart, so if you see here, it was down, then it tried to go up, and it broke. So, in my opinion, this level of till the time this level of 25 to 50, this level is not crossed, there is no strength. Otherwise, it will just keep going up and coming down. And 24, 900, 920, 930 is the key level to see at the downside. Otherwise, we will see lower levels. It is looking slightly over. So a small rise will get sold. So let's see. It is below all the moving averages, so it is looking weak. Nifty Bank again, the breakout has been defeated on the weekly charts. Nothing much here. Same Nifty Bank. This is looking weaker because it went down with a gap down after on Friday. So it is now again decisively below the 20 EMA, and I think it will test this 56,000 level now based on the results which are coming and anticipation of what is expected from here. RSI is also down, so it is momentum is down. It is looking down right now. So it's a clear Nifty Bank is a clear short right now. HDFC Bank again has taken support at 50 EMA, went up after above this, but I think this should break now, and we should see lower levels. Let's see how the market takes it. Reliance again, it was below the 20 EMA and may trade in this range only. I think results were not that bad or not that good. It was just neutral. So let's see what happens. It depends also on any other news flow which is related to this stock. Midcaps made went up to the previous high, then it corrected, but these are the stocks where even result wise they are doing well. And small caps also made were up last week. So this segment of the market is looking good, mid caps and small caps, where there is which are mostly domestic economy facing stocks. So this is how what is a technical setup. Now I'll cover two stocks today. First is the KEI Industries. So if you see the bigger picture, India's cable and wire industry is expected to grow around 12% over the next 3 years, supported by capex initiatives across segments. So there is a lot of government capex which is taking place in roads, railways, urban infra, other infra, energy. So this is where it comes into play, along with others, and transport. Uh, and exports are key contributors, and India's shares in cable and wires export is expected to rise now. So from around 0.5% around 10-15 years back, it has come to 1.3%, which is good. And the other shift which is taking place is that share of organized players is rising vis-a-vis unorganized players. So if you see here, it is already at 76.24 and has been constantly rising in cables and wires and will rise further. So this is why the the listed players are moving, and especially the ones which are big and have good capacity. So KEI is the India's second largest cables and wires player with a well diversified channel. They are creating a greenfield capacity at Sanand, which is coming on board maybe in first quarter. It will start FY26. It should be well positioned to achieve their revenue and EPS CAGR of 19 to 20% respectively. So they are talking about 18-19% revenue and profit growth. Margins are expected to rise as the revenue mix improves, supported by growth in exports, 32% CAGR over next 3 years, and new extra high voltage capacities inherently higher margin. They are uniquely placed in extra high voltage cable segment as a market leader because they are one of the few Indian manufacturers capable of producing EHV cables above 220 kilowatt and 400 kilowatt. Even Polycab is now trying to get into this segment, and it takes a lot of time for approvals and other things to come through. Uh, Exemplary track record of setting right strategies such as deferring FMEG. So they are out of this FMCG. They're not trying to diversify into this. Fast moving electrical goods, increasing share of retail. So I'll show you, they have constantly increased their share of retail in their selling, which has helped their cash flows, reducing EPC business, and executing all these changes well. So because of that focus on retail, the margins are higher than in institutions. In retail, working capital requirement is lower and reduce their receivable days. A trend of market share gains has been witnessed across all major organized players. It's primarily the smaller unorganized players that have lost market share to their organized counterparts, as I have shown you. Export contribution to rise to 18 to 20% of the revenue by FY27 because this upgradation of transmission and distribution facilities is taking place all over the world. Now, this is a very unique thing. 70% of the dealer distributors are covered under the channel financing program. Basically, channel financing program is that the company sells the stuff to the dealer. They have also tied up for financing of the dealer for the stuff they have sold to them. So the company gets their money very quickly. So their cash flow is good, and as the dealer sells the stuff, they pay to the channel financer. So that way the cash flow is very good and the stuff gets sold. So this is the basic stuff, and that's why their cash flow is good. Now, if you see here, India's cable and wire industry size is growing around 8% till now. It is expected to keep growing like this, but it has reached roughly 90,000 crore in FY25. KEI's domestic revenue is around 8,100 crore. So roughly it is 9%. But if you see FY 2018, they were 4.5 and now they have increased their market share to 9%. So it has doubled over the last 6-7 years. So this is a unique thing. They are growing and taking on the market share from others. Now in their revenue segment, cables and wires is 94%. As I told you, they have shifted from EPC and EPC segment and other FMEG they have not gone into. And stainless steel wires is small 2%, EPC is around 4%. So historically, if you see here, from FY18, they were around 72% and EPC were 25%. So they have brought it up to 91% in cables and wires and 7% in EPC. So the focus, strategic plans, growth trend in segments. So if you see here, cables is growing steady above 20%. Stainless steel wires is also growing now, and EPC project is coming down. CAGR of revenue segment, if you see here, cables is around 19%, stainless steel wires is 9%, and overall is around 15%. So what they have done is they have increased, as I told you, their retail share. So from around 28% in FY25, they have reached already 52% of the retail share, and institutions are around 35%, and export is around 13%. So what they are trying to do is keep the retail at around 50%, increase the exports to around 18%, and reduce the institutions, because institutions, they don't have pricing power with the institutions as compared to retail. So what this has led to is reduced their receivable days. So receivable days has reduced from 100 plus to around 63 now. So that helps in cash flows and requirement of working capital. Continuously increasing their dealers count. So their dealers have increased, which is the real moat for them. So actually, the value is because of the number of dealers they have, nothing else. This is the most important issue because that's how their stuff is sold. And geographical split is generally the same, basically in West and North, East India and South India. So they are generally everywhere. Wherever they are less, they will try to grow. Exports revenue are increasing. So they have reached 13%. They are targeting 18%. Capacity utilization, so if you see, is around 85% in cables now. Uh, and others is slightly lower. And stainless steel wise around 89%. So, and uh, the number of countries it is exporting is increasing. So now because of this, they are doing capex, because if the capacity utilization 85% and you want to grow 20% every year, you have to do capex. So now they have increased their capex and they have done around 618 crore in FY25 and for 400 crore in FY24. So their manufacturing capacity as of March 25 are in Bhiwadi, Rajasthan, Rakholi, Dadra Nagar, Chopanki, Rajasthan, Pathradi, Rajasthan. Pathradi, they have two plants, and in Dadra Nagar, Haveli, and Daman and Diu. And now another capacity is coming up in Sanad, Gujarat. So they are creating greenfield and brownfield growth they are doing. So they are doing continuous capex, and it is planned till FY28. CAGR of revenue growth is around 19%, which is expected over the next 3 years. EHV capacity commissioning to drive higher margins, so that's why they are expecting higher margins, because EHV is a higher margin business, so the margins will grow to 10% plus, resulting in EPS growth of CAGR of 20%. So basically, it is 18-19% revenue growth and 20% PAT growth business with gaining of market share. So coming to, they are doing around 18-20%, as I told you, sales, which is expected to continue in FY26. EBITDA margins are improving. EBITDA growth is around 20% because margins are improving. And EPS growth is around 20-21%. So they are expected to do FY26-27 around 88 and 106. So even if you take around 100 as average earnings at 40 times, this is fully priced. So in my view, 4,000 is the price, is a fair value for this, maybe slightly lower also. Asset turnover is good, so that will add to greater revenues for them. ROE it has come down because they had done a QIP in FY24. They did around a 2,000 crore QIP, so the ROE came down because the share capital increased, but now it is gradually improving. PE is, as I told you, around 40 times FY26, which is, I think, fair value right now. So let's see where it goes. So if you see here, it made a high of around 4,800, then it dipped to 2,400, so became half actually, based on the news of this was related to Trump tariffs and related to other issues like other players coming into the same segment like Adani and JSW, etc. But then it has bounced back. So it has reached around that 4,000 level. I think this is fairly priced. So you have to wait for a decent dip to somewhere around. So in the last week, it has gone up around 8.76%. In addition, because the Polycab results were good, this has also got some momentum and good decent volume. So this is a buy on dip stock. Somewhere around 3,600 is a good level to buy this stock so that you can get some returns. Next stock is Vishal Mega Mart. Now I'll show you today why the established players like HUL, Bata, Britannia, Nestle, etc., and Marico, etc., are not able to sell their products. It will be very clear to you. Now, if you see, this is Vishal Mega Mart's own brand noodles called First Crop. They're selling at 33 bucks, cheaper than Nestle's Maggi, which sells at 56 bucks. Then their brand of biscuits, First Crop at 80 bucks, cheaper than the branded players which are coming at around 100. So direct competition to Britannia. They are competing with Nestle. Now they have private label shower gel, which is at 180 bucks compared to 250 from Nivea. So direct competition there. Then kurtis are starting at 300 bucks. Shirts coming at around 500 bucks. Shoes, footwear, 400 bucks. These slip-ons and casual footwear around 300, 400 to 500 bucks. So they are starting at these price points, and this is the main reason why the established players, big players, are not able to sell. And these guys are mostly in tier 2 and tier 3 cities. So it's a unique Indian retailer with a strong presence in tier 2 plus cities, 690 stores, 696 stores in 458 cities, well diversified exposure to key consumption baskets. Now the other difference is they are into all three segments: apparels 44%, general merchandise and fast moving consumer goods 28%, both 28%. So basically three segments are apparels, general merchandise and fast moving consumer goods. So if you see, some players like DMart are in FMCG and very less in apparels. Some like Trent are only in apparels, but these guys are in all three. And general merchandise, I'll show you what all they sell. With a strong, affordable private brands portfolio of 73% revenue share and one of the lowest cost structures in the industry. And the beauty is that all the contract manufacturers of HOL are also their contract manufacturers. So what happens is the quality is ensured in terms of product, and only thing is that they get lesser price point. It has successfully established a diverse and expanding portfolio of 26 own brands across key consumption baskets. It operates a 100% private label portfolio across men's, women's, and kids' fashion, covering a wide range of categories such as denim, ethnic wear, innerwear, and sportswear. It has expanded its own brand offering in general merchandise under Tandem brand for home appliances, introducing products such as air fryers, garment steamers, sound bars, kitchen tools. So it is direct competition to Havels and Philips and all such people who are making such products. Its private label in FMCG are sourced from reputed vendors such as Indonesia, Bikaner Wala, and CCL products are priced at a significant discount to branded competitors. It operates a big box retail format with an average store size of 17,500 square feet. So big box retail format is where in a one store you get everything. So so you take care of all requirements. So generally their store is in three floors. So the ground floor is basically the apparels. Then the first floor is general merchandise, and the top floor is FMCG. So this is how they generally set up a store. Efficient working capital management, superior cost controls, and disciplined asset-light approach has enabled strong store economics with 15% EBITDA margin at store level, over 50% ROCE, and a payback period of less than 2 years after they establish a store. So expect 13% CAGR in store additions over FY 25-28, taking a total store count to 1,000 by FY 28. This is what they are guiding for. So from around 696, 700 stores, in next 3 years, they are guiding that they will have 1,000 stores. So what is the distribution is, if you see at FY 25, out of 696, 504 stores are in tier 2 and tier 3, and tier 1 is 192. And this tier 1 is Bangalore and Delhi. Now, 67% of BMM stores are in North and East India. So basically North and East, and they can grow in South and West because South and West have other established players. Apparel is the largest category of VMM, accounting for 44% of the revenue, and 28 odd is for general merchandise and FMCG. A share of own brands is 73%. So 19% CAGR in revenue over next 3 years is expected. EBITDA margins are expected to improve and reach around 10% over the next 2-3 years versus 9% now. PAT CAGR, which is expected, is around 24% over the next few years, and PAT margins are expected to grow, and good cash flows. So that is another advantage. Now, what happens is their cost of retailing including rentals at 150 rupees per square feet per month is one of the lowest among value retailers in India. So this is their advantage as compared. So if you see their margins are or their cost for retailing is the lowest as compared to all other players. So if you see we do retail 188, uh, Mart 201, Style Bazaar 176, Mart 197, and Trent 383. So because their rentals and cost of retailing is less, they are able to maintain decent margin as compared to others. Only Trent has higher margins, but because their gross margins are higher. So this is their basic advantage in terms of how they have established their business. Now they have got major share in three states: Uttar Pradesh, Karnataka, Assam. So now they're trying to grow in other states. So 35% of the share is in three states only, and revenue concentration is 36%, and throughput is top three state is around 13 million per store per month. Now they own the opening price points across several categories. So if you see t-shirts from 99 to 599, kids wear, ethnic wear around 2000 bucks, men's shirts 200 to 800, denims 300 to 1200, slippers, double bed sheets, spin mops, burner gas stove, kettles, Bourbon biscuits, dishwash liquid, Navratna mixture. Now, if you see, they are taking on the established players, fruit juices, noodles, which is a big segment for Nestle, etc. Now, in their tandem product, they are selling all these electronic goods. So they started in FY21, and at FY25, they are selling additions are wet grinder, mixer grinder, blender, multi-cook kettle, glass kettle, mixer grinder, non-stick ceramic coated cookware, induction cooktop, uh, three-ply non-stick cookware, study lamps, etc. So these products coming at lower price, they are taking on all the established players at and with far higher growth in sales. Now, if you see the discounts, very simply, if you see cashew biscuits, they are taking on Good Day at around 20% price below them. Then Mary, they are at 20% discount to Mary biscuit. Aloo bhujia, they are taking on Haldiram with 15% discount. Similarly, if you see here, masala noodles to Maggi, they are at 33% discount. Ghee, they are at around, to Amul, they are at 19% discount. Rice, they are to India Gate around 13% discount. Bathing soap to Pears and Parachute oil, they are coming at around 37% discount. And hence, they are taking out these brands. And then in home care, they are roughly around 30 to 40% discount to Rin, Vim, Odonil, etc. So they are like running a mini CSD actually. So this is the basic reason why the established brands are struggling, because these small towns and all, these guys are selling. Plus, you have a good store which is air conditioned. People love to go there. And as I told you, FMCG is at the top. Bottom is apparels and then general merchandise. So they're getting good sales. Now, if you see here, their income is expected to grow 20% over the next 3 years. Margins are expected to remain in this 28% plus state. EBITDA margins are growing, and PAT is expected to grow now around 23 to 25%. Now, that risk is there. So, that big phase of PAT growth of 30, 40, 50% is over now. So, they will now grow. So, that risk will be there, because we have seen with Trent, nobody is able to maintain that fast pace of growth. EPS is expected to be around 1.7 and FY27 2. So taking around 2 for FY26-27, in my opinion, around 50 times should be a fair price for this. Above that, it becomes expensive. 50 or 60 times. So 100 to 120 rupees should be the value zone for this stock. Return ratios are improving. Asset turnover is good, and inventory days are coming down. So it reduces their working capital cycle. Now, this stock is after the listing. the new listing, it went up, came down. It had come down to 100 levels, and now it has gone up. It has gone to 138 after there was a coverage by one of the brokerages. So be careful. This is right now expensive. Somewhere around 100 to 120 is a good level to buy this stock for long term, because at these price points, how much more money can you make on this stock? And there is a risk of lower sales and other issues later. I've finished. We'll take questions now.